So what on earth is behind the massive, earth-shaking surge in precious metals that we saw at the start of 2026? Today, we're going to break it all down.
Okay, first up, gold. It didn't just climb, it completely shattered the $5,000 barrier. And you have to understand, that is a huge psychological line in the sand. This wasn't just another trading day. It was a milestone that sent some serious shockwaves through the entire global system.
But, as big as that move in gold was, silver? Well, silver was on a whole other level. A staggering 147% gain in the previous year alone. It just blew past the $100 mark for the very first time. Absolutely explosive stuff.
So this brings us to the big question, right? Is this all just a speculative frenzy that's going to pop? Or are we actually looking at a permanent, fundamental shift in how the entire world values money, risk, and what is truly safe?
All right, so here's how we're going to break it all down. First, we'll look at the rally itself. Then, we'll get into the global risk factor. After that, the great debasement trade and silver's unique supply squeeze. And finally, we'll see what the big banks are forecasting now.
Okay, first up, let's just dig into the anatomy of this rally because the sheer scale and power of this move, well, the numbers are pretty mind-blowing.
Just look at these numbers. A 64% return for gold in 2025, that's its best year since 1979. And then it actually accelerates into 2026. And silver? It's just gone completely vertical. The big takeaway here is that analysts are literally tearing up their old spreadsheets. They're being forced to recalibrate everything for a totally new reality.
And here's something really interesting the analysis points out. The whole psychology of the market has flipped. You know how some good news would hit and precious metals would sell off? Not anymore. Now, every single dip is getting bought up instantly. That tells you there's a really deep, underlying conviction that the big drivers, debt, instability, they aren't going anywhere.
All right, part two. This brings us right to what the report identifies as the main catalyst for all this, a totally new and frankly unpredictable era of geopolitical uncertainty.
This concept, the geopolitical risk premium, is absolutely central to understanding what's going on. See, investors aren't just buying gold to hedge against inflation anymore. No, they're hedging against chaos, trade wars, sanctions, the unpredictable actions of world powers. It's like a permanent fear tax is now being priced into hard assets.
And this timeline from January just shows you how wild things got. Look at this. A diplomatic deal is announced. The market takes a quick breath, and then boom, silver rips past $100. Gold hits a new record, and another trade dispute blows up out of nowhere. Diplomatic crises are now translating directly into asset prices in real time.
And if you want a perfect example of this new reality, look no further than the Canadian situation. A 100% tariff threat against Canada, one of America's oldest allies. That just demolishes every old assumption about safe trade. If that relationship isn't safe, then what is? It forces everyone globally to rethink risk. And where does all that capital run for safety? To the one asset that has no counterparty risk, gold.
Okay, part three. Beyond all the dramatic headlines, the analysis points to a much deeper, more structural problem. This isn't just about politics. This is about a global vote of no confidence in paper money itself.
And here is the key concept: fiscal dominance. It sounds complex, but it's actually pretty simple. It's when a government's debt gets so enormous that the central bank basically has its hands tied, it's forced to just print money to pay the bills. It's a mathematical trap, and the end result is always the same. It devalues the currency.
So who's paying attention to this? You better believe other countries are. There's this quiet revolution happening behind the scenes with the world's central banks. They're systematically dumping their U.S. Treasury bonds and swapping them for physical gold bullion. It's a strategic move to protect their national wealth from political risk and a devaluing dollar.
Now let's turn to silver, because the analysis argues it's a whole different animal. It's in this unique, powerful supercycle where all the monetary panic we've been talking about collides head-on with a severe physical supply crisis.
This chart gets right to the heart of silver's problem. You've got these two massive technological revolutions, green energy and AI, and they're just vacuuming up all the physical silver supply. Solar panels, electric vehicles, AI data centers, they are devouring it, leaving very little left for investors.
And here is the absolute killer detail. Unlike gold, you can't just decide to mine more silver. The supply is what they call inelastic. Why? Because about 70% of it is just a byproduct of mining for other metals like lead and copper.
So even with the price going to the moon, miners can't just flip a switch and produce more. This creates a genuine, historic, physical squeeze. So you take all of these powerful factors converging at once, and what happens? Well, the analysis shows how major financial institutions have been forced to tear up their old forecasts and rush out some pretty shocking new ones.
I mean, just take a look at this. Bank of America is calling for $6,000 gold. Goldman Sachs is at $5,400. Think about that for a second. These numbers, which would have sounded completely crazy just a couple of years ago, are now the sober, mainstream consensus view on Wall Street.
And it's not just the big banks. The analysis also includes perspectives from outside the establishment, like Robert Kiyosaki. He's been arguing that a crash in paper money is coming, and that the people who hold real, tangible assets like silver are going to be the new wealthy elite. His price targets, by the way, make Wall Street's forecasts look timid.
So ultimately, what does this all mean for us? This isn't just about lines on a chart. The analysis argues that what we're witnessing is a massive, historic transfer of wealth, away from people who hold their savings in cash and toward those who hold hard assets.
And that leaves us with this final provocative thought. The 2026 precious metals supercycle isn't just another bull market. It's a global distress signal. It's a vote of no confidence. So, the question is, what happens when the world's faith in paper money finally begins to unravel?